Welcome to this FRM tutorial on types of risks. In this session, we'll explore the various risk categories that financial institutions face and why understanding them is critical for effective risk management. This comprehensive overview will prepare you for the FRM examination and real-world risk analysis. Let's start with the fundamental question: what is risk? In financial risk management, risk is defined as the uncertainty regarding future outcomes that may negatively impact an organization's objectives. Think of risk as having four key dimensions. First, it represents the potential for financial loss or adverse outcomes. This is the downside we're always concerned about. Second, risk means variability in expected returns or results. The more volatile, the riskier. Third, it's about exposure to uncertain economic conditions that we cannot fully predict or control. And finally, and this is crucial, risk must be identified, measured, and managed. We can't eliminate risk entirely, but we can understand it, quantify it, and implement strategies to control it. This is the foundation of enterprise risk management. Now let's look at how we categorize risks at the highest level. Risks are broadly divided into two major categories. First, we have financial risks. These include market risk, credit risk, and liquidity risk. These are the traditional risks that arise from financial transactions and market movements. They're typically easier to quantify using mathematical models and historical data. Second, we have non-financial risks. These encompass operational risk, strategic risk, and compliance risk. These risks are often harder to measure because they involve human factors, processes, and external events that may not follow predictable patterns. Understanding this distinction is important because different risk categories require different management approaches, measurement techniques, and governance structures. Let's dive into our first major risk type, market risk. Market risk is the risk of losses due to changes in market prices and rates. It's one of the most visible and actively managed risks in financial institutions. Market risk has four primary components. First is equity risk. This is the risk of losses from stock price fluctuations. If you hold a portfolio of stocks, adverse movements in equity markets can erode your portfolio value. Second is interest rate risk, which affects bond prices. Remember, bond prices and interest rates move inversely. When rates rise, bond prices fall, creating losses for bondholders. Third, we have currency risk or foreign exchange risk. This arises from movements in exchange rates and affects any institution with cross-border exposures or foreign currency positions. Finally, there's commodity risk, the price volatility in commodities like oil, gold, or agricultural products. This affects not just commodity traders, but also companies that use these inputs in their operations. Market risk is typically measured using value at risk or VAR and stress testing methodologies. Next, we have credit risk, the risk that a borrower will default on their obligations. This is particularly important for banks and lending institutions. Credit risk manifests in several forms. Default risk is the most straightforward. It's the failure of a borrower to repay principal or interest when due. This is what most people think of when they hear credit risk. Counterparty risk is specific to over-the-counter derivatives. When you enter into a swap or forward contract, you're exposed to the risk that your counterparty may fail before the contract matures. Settlement risk, also called Herstat risk, occurs in payment systems. There's a brief window where you've delivered your side of a transaction but haven't received payment yet. Finally, concentration risk arises when you have excessive exposure to a single borrower, industry, or geographic region. Even if individual credits are sound, concentration can be dangerous. Remember the saying, don't put all your eggs in one basket. Credit risk is managed through credit analysis, collateral requirements, credit limits, and portfolio diversification. Liquidity risk is often underestimated but can be fatal to financial institutions. We saw this clearly during the 2008 financial crisis. Liquidity risk has two main dimensions. Funding liquidity risk is the inability to meet cash obligations when they come due. Imagine a bank that can't meet deposit withdrawals or cannot roll over its short-term funding. This can quickly lead to insolvency, even if the institution is technically solvent on paper. Market liquidity risk means you cannot exit positions at fair prices without moving the market significantly. In stressed markets, bid-ask spreads widen dramatically, and what was once a liquid asset becomes illiquid. A common source of liquidity risk is asset-liability mismatch, timing gaps in cash flows. For example, funding long-term assets with short-term liabilities creates a maturity mismatch that becomes dangerous when you can't refinance. Liquidity risk becomes critical during financial crises and market stress periods. Many institutions that failed during 2008 didn't fail because they were insolvent. They failed because they ran out of liquidity. This is why stress testing and liquidity coverage ratios are now central to banking regulation. Now let's move to non-financial risks, starting with operational risk. This is defined as the risk of loss from inadequate or failed internal processes, people, systems, or from external events. Operational risk has become increasingly important, especially with the rise of technology and cyber threats. Let me highlight three major sources. Internal fraud involves employee misconduct, things like unauthorized trading, theft, or manipulation of records. Think of rogue traders like Nick Leeson, who brought down Barings Bank. External fraud includes cybercrime, hacking, theft, and increasingly, ransomware attacks. Financial institutions are prime targets for cybercriminals. System failures cover IT and technology breakdowns. In today's digital banking environment, a system outage can halt operations completely and damage customer trust. Let's break down operational risk further into its four main sources. Process risk arises from flawed procedures and workflows. Maybe your reconciliation process has gaps or approval procedures aren't properly designed. These process weaknesses can lead to errors or enable fraud. People risk encompasses human error, incompetence, or inadequate training. Even with perfect processes, people make mistakes. The risk increases when staff are poorly trained or when there's inadequate supervision. Technology risk includes system outages, software bugs, and cyber attacks. As financial services become more digital, this risk grows exponentially. A single cyber attack can compromise millions of customer records. Finally, external events are things largely outside your control. Natural disasters, terrorism, pandemics, or sudden regulatory changes. While we can't prevent these events, we can plan for business continuity. The Basel Committee has identified 7 categories of operational risk events, and banks must hold capital against operational risk exposures. Legal and compliance risk has become increasingly prominent since the 2008 crisis, with regulators imposing substantial penalties for violations. Regulatory risk involves violations of laws and regulations. Financial services is one of the most heavily regulated industries. Violations can result in massive fines, restricted operations, or even criminal prosecution of executives. Legal risk covers lawsuits, litigation, and contractual disputes. This could be customers suing over missold products, counterparties disputing contract terms, or employment-related litigation. Compliance risk is about non-adherence to internal policies and procedures, even when they go beyond regulatory requirements. Many institutions have policies stricter than regulations require, and violations still create risk. An important point, legal and compliance failures often lead to reputational damage from regulatory actions. A major regulatory penalty doesn't just cost money, it damages trust and can lead to customer departures. The indirect costs often exceed the direct fines. Strategic risk arises from poor business decisions or changing market conditions that affect the long-term viability of the organization. Competition risk involves market share erosion. New entrants, especially fintech companies, are disrupting traditional banking models. If you don't adapt, you lose customers and revenue. Technology disruption represents innovation threats. Think about how mobile payments, blockchain, and digital currencies are challenging traditional banking. Institutions that fail to innovate risk obsolescence. Business model risk is about your fundamental approach becoming outdated. The business model that worked for decades may not work in the digital age. Kodak is a classic example. They had the technology but failed to adapt their business model. Strategic risk is often the hardest to manage because it requires forward-looking vision, not just analysis of historical data. It's managed through strategic planning, market intelligence, and willingness to transform. Reputational risk is damage to brand image and public perception. In financial services, trust is everything. Reputational risk manifests as loss of customer trust and confidence. Once customers lose faith in an institution, they take their business elsewhere. In the digital age, negative news spreads instantly through social media. Here's a crucial insight. Reputational risk is often a consequence of other risk types. A major operational failure, a compliance violation, or a credit crisis can all trigger reputational damage. It's a secondary risk that amplifies primary risks. The consequences can be severe: deposit runs in banks, client departures in asset management, or inability to attract talent. Reputational risk is particularly dangerous because recovery is slow and difficult. You can lose your reputation overnight, but it takes years to rebuild. This is why institutions invest heavily in corporate communications, crisis management, and stakeholder relationships. Model risk is increasingly important as financial institutions rely heavily on quantitative models for pricing, risk measurement, and decision-making. Model risk arises from several sources. First, there's incorrect model design or assumptions. Your model might be based on assumptions that don't hold in reality, or it might not capture important risk factors. Second, improper use of models for pricing and risk assessment. A model might be appropriate for one purpose, but misapplied to another, or users might not understand the model's limitations. Third, data quality issues and parameter errors. Remember, garbage in, garbage out. If your input data is flawed or your parameters are incorrectly calibrated, your model outputs will be wrong. Finally, failure to validate and update models. Markets evolve, relationships change, and models need regular validation and recalibration. The 2008 crisis highlighted model risk. Many risk models failed to capture tail risks and correlations during stressed conditions. This led to increased focus on model risk governance, validation, and stress testing beyond model outputs. A critical concept in risk management is that risks rarely occur in isolation. They're interconnected and can amplify each other. Consider this. Market stress triggers liquidity problems. When market volatility increases, margin calls rise and funding sources dry up. What starts as market risk becomes a liquidity crisis. Credit losses lead to reputational damage. When a bank announces significant loan losses, depositors worry about safety, potentially triggering withdrawals. The credit risk event creates reputational and liquidity risks. Operational failures cause compliance violations. A system failure might lead to missed regulatory reporting deadlines, turning an operational issue into a compliance problem with potential penalties. This interconnection is why we need enterprise-wide risk management, not siloed approaches. Risk limits must consider correlations between risk types, and stress testing must model multiple risks simultaneously, not in isolation. The cascading nature of risks means that seemingly small issues can spiral into major crises if not managed proactively. Let's conclude with 3 key takeaways from this tutorial. First, multiple risk types require integrated management. You can't manage market risk in isolation from credit risk or operational risk separately from strategic risk. They're interconnected. Second, risks are interconnected and can amplify each other. A single risk event can trigger cascading failures across multiple risk categories. This is why stress testing and scenario analysis are so important. Third, effective risk management is core to financial stability, not just for individual institutions, but for the entire financial system. The 2008 crisis taught us that risk management failures can have systemic consequences. Thank you for watching this FRM tutorial on types of risks. Understanding these risk categories is fundamental to becoming an effective risk manager. In future tutorials, we'll dive deeper into measurement techniques and management strategies for each risk type. Before we conclude this session, let's test our understanding with a few FRM-style conceptual questions. These questions are designed to resemble the type of conceptual traps you may encounter on the FRM exam. Try to answer each question before looking at the explanation. First question. Which of the following statements best defines risk in modern financial risk management? A. Risk is the probability of a loss occurring. B. Risk is the possibility that a portfolio generates negative returns. C. Risk is the variability of outcomes around an expected value. D. Risk is the likelihood of default by a counterparty. Take a moment to think about this. The correct answer is option C. In modern finance, risk is defined as the variability or dispersion of outcomes around an expected return. Notice the important distinction. Risk does not only refer to losses, it refers to uncertainty of outcomes, including both upside and downside variation. This definition is fundamental throughout the FRM curriculum. Next question. Which of the following risks cannot be diversified away in a well-constructed portfolio? A. Idiosyncratic equity risk. B. Firm-specific management risk. C. Systematic market risk. D. Specific credit risk. Take a moment. The correct answer is option C. Systematic market risk. Systematic risk affects the entire market, such as macroeconomic shocks or interest rate changes. Because it impacts all assets simultaneously, diversification cannot eliminate it. In contrast, idiosyncratic or firm-specific risks can be reduced through diversification. Third question. Credit risk materializes only when A. A borrower has poor creditworthiness. B. The financial institution holds a position that is an asset. C. The borrower's credit rating deteriorates. D. Interest rates rise. Think about when a loss can actually occur. The correct answer is option B. Credit risk becomes relevant only when the financial institution holds a position as an asset. For example, if a bank lends money, the loan is an asset. If the borrower defaults, the bank suffers a loss. However, if the institution owes money to someone else, the liability position does not create credit risk for the institution. Fourth question. Which situation best illustrates market liquidity risk? A. A bank cannot raise cash to meet margin calls. B. A firm cannot sell a large bond position without significantly affecting its price. C. A bank cannot roll over short-term debt obligations. D. A borrower fails to repay a loan. Take a moment. The correct answer is option B. Market liquidity risk occurs when an asset cannot be traded quickly at the prevailing market price without significant price impact. Options A and C describe funding liquidity risk, where the institution cannot obtain the cash required to meet obligations. Final question. During a financial crisis, a bank experiences rising loan defaults. These defaults cause lenders to withdraw short-term funding, forcing the bank to liquidate assets at depressed prices. This sequence best illustrates A. Market risk leading to operational risk. B. Credit risk leading to liquidity risk leading to market risk. C. Liquidity risk leading to credit risk leading to reputation risk. D. Strategic risk leading to operational risk. Think about the sequence of events. The correct answer is option B. This example illustrates risk interaction and cascading effects. The sequence is: first, credit risk increases because borrowers default. Second, lenders withdraw funding, creating liquidity risk. Finally, the bank must sell assets quickly, generating market risk losses. This type of cascade occurred during the 2007-2009 financial crisis. To summarize, this reading introduces different types of risks and their interactions in a cascading way. You should now understand the formal definition of risk, the difference between systematic and idiosyncratic risk, how credit risk arises, the distinction between funding and market liquidity risk, and how risks can interact and cascade across financial systems. These concepts form the basis for more advanced topics such as value at risk, credit modeling, and stress testing, which we will explore in later readings. Thank you very much, and see you in the next video again.